Sorry, I blanked it. Really sorry. She is with Ergon. She has been credit and risk manager for since 2016. She focuses mainly on the risk mitigation from an international perspective, and she is the LC liaison for Ergon globally. She is a kind of a unicorn in her position in the fact that she got her CDCS in 2004. And then in 2020, she got her CTFP, and in 2025, her CITR. So she is well certified and knows, she knows the real life in the books. So next, we're going to go with Rene Osorio, and he's CEO of Sunrise Foods International. Renee's background is in the agribusiness and food ingredient company. They source and process and deliver high quality, premium, organic, non-GMO foods. He brings over 25 years of global leadership. Before that, he was with Cargill and also with Colgate, Palmolive, PepsiCo. Welcome, Renee.
Thank you.
And last, we have Sebastian Vivenko. He has got 20 plus years in the commodity industry, spanning commodity trading houses and international banking. He began his career in the trading corp world. He's been with Glencoe, Trafigura, Cofco, and he does physical trading, risk management, trade financing, and logistics in the emerging ag, and moved to banking. When did you move to banking?
10 years ago.
Okay, yeah, about 10 years ago. And he's worked with HSBC, Valley National, and he's currently with Sumitomo Mitsui Bank and leading the commodity and trade finance. And we learned today at lunch that he went to university in Tulsa, where I am from, so small world. And he actually worked with a boss that I had at Traffy. So
small world.
Yeah, very small world, even though we're, always talking globally. Okay, so let's get us kicked off with our first round of questions. Okay, so we're just going to kind of do a round robin of questions as we were talking about how we wanted to present this and what we want to talk about. We just decided that, we're going to go around the room or around the panel and see what everybody is experiencing. So our first question that we're going to pose to them is, how would you characterize the evolution of commodity markets from 2020 to 2025? And we're going to go ladies first.
This one's tough. We have seen massive growth during COVID. I have to back up just a little bit with COVID. We weren't doing, obviously, as much international at that time, but Ergon also has asphalt company. We sold a whole lot to the cities and the states. So your roads got done during COVID, didn't they? So that was one thing. Globally, in the past 5 years, we've seen massive growth. Infrastructures in foreign countries are growing. So our transformer oil segment has been booming. So the risk, though, has been there. So how do we mitigate that risk? That's been rather eye-opening because everybody wants supply chain financing, and I am risk averse. So I'll do letters of credit, standbys, documentary, demand guarantees, but we've also put heavy emphasis on credit insurance.
Thanks. I mean, why not? You got to protect yourself.
Because it's my money till it hits the bank. Then it's the boss's money.
Good point. Renee, you want to go?
Yeah, sure. So I think in our case, if you think about the changes that we have seen since 2020, just like Anne mentioned as well, I think we started with a positive impact in terms of our business with the situation we have in COVID. I think just for you to have a reference, what we do is to help customers that are producing food or feed with the ingredients that they are using, organic ingredients that they are using to produce those. Specifically, especially in the part of feed, it's a huge impact that we have in the industry because we represent 70% of the cost that the customers that are producing chicken or eggs that are organic were supplying 70% of the materials that they use to produce those. So you can imagine pressures that we're seeing today in terms of inflation, especially after COVID, that didn't help once we move into the tariff season. And also, in our particular case, the U.S. is almost always in deficit of organic ingredients because of the nature of the supply chain that is well prepared and structured to produce more what we call conventional cereals. So always the U.S. is in big deficit and needs to import organic raw materials. And most of that material, it's coming today from different origins, but Black Sea, it's a big part of that supply chain. So you can imagine when I'm saying Black Sea, I'm also referring to countries that are in a difficult situation today, like Ukraine. And so in our case, also there was a big impact that we had to manage during this time. And also, like Anne said, in terms of risk management was a big portion of our efforts to try that ultimately our customers were less impacted by disruptions in their supply chain for these events like wars or disruptions with tariffs that also affected all the inflation and the impact that we're seeing as consumers today every time we go to the supermarkets. So today, I think we are in the business of trying to keep being creative on how we mitigate those risks and how we can offer ultimately products that are at the most competitive cost to those producers. So ultimately, the consumers in our business, mainly in the US and Europe, can have the possibility to offer great solutions for the final consumers.
Thank you, Renee. Okay, let's hear.
Thank you,
Yeah.
Lisa, for the introduction. First, a pleasure to be with you in this panel. I guess, since 5-6 years ago, COVID, the start of the Russia-Ukraine war, had various weather effects, geopolitical events that have brought on tariffs. But I probably would like to highlight as probably the biggest shift really is a shift from a globalized, least cost or more cost-effective single corridor supply chain to really a regional resilience-based approach where either redundancies in regions and political alignment together with optionality. I think optionality is very, very big. And in the clients that I cover, optionality is something that they've had, this value add for a very long time. The ability to look at different importers, exporters, or refiners, distributors, wholesalers across the supply chain is very valuable. Also, optionality in logistics, whether it be moving commodities from different parts, using different inventory locations, using different feedstocks for different blends, et cetera, and especially lately financing. We've seen a lot of financing tied to offtake. We've seen that in structured trade finance. We were talking earlier about regional reshoring with inventory financing products, or whenever you have regional trade bringing in more tier 2, tier 3 suppliers where you anchor them to a bigger investment grade buyer. Just some of the examples that have made, financing a very, very important term the last 5 years, and even more in the last couple of years.
Which I love that, you kind of ended on that, because at the end of the day, I hear people say, oh, it's like traditional, letters of credit, blah, blah. That is financing. I think that sometimes we're like, you can't see the forest for the trees. We're so embedded in that. But it is financing. I mean, someone is getting financing. Someone is, taking on or risk mitigating. I mean, with your guarantee, with your letter of credit. I mean, that's the whole purpose. So I really appreciate that first round of feedback. Okay, moving on to our next question. what were the most significant operational and financial pressures during this period? Do we want to go reverse this time? Yeah, okay, here we go reverse.
Would you like me? Okay, I can maybe highlight a couple. One, I guess, is more inherent within the business. I mean, trading firms at many points in time might fix one leg of a physical transaction and the other remains open. And in order to hedge that market price risk, they'll put on derivatives, whether it's a future or an option. And then that derivative is open to mark-to-market calls, margin calls, and price volatility lately has made those margin calls significant. So it's always been a cost of doing business for trading firms, but price volatility has taken that up a notch. And then also there's commodities that trade many years into the future, where commodity trading companies really need to assess whether, okay, am I going to keep that hedge for 5-6 years or so? And what is the opportunity cost to use that capital to do something else? That is inherent for so one. Then the other one might be more tied to operational logistics. We've seen delays in the Panama Canal transit because of droughts. The Red Sea blockade, Red Sea security issues and the Suez Canal blockade. And that has extended the cash life cycle and the stressed working capital facilities. So I guess the takeaway there is that you really can't look at risk management, operations, and liquidity or financing independently of each other, and they really kind of go together.
Perfect. Renee?
Yeah, I think in our case, probably there are two factors that today are the ones that we are more focused, concerned, and putting more efforts on how we transition to that. I think one, that probably both are summarized as trade wars, right? So within that, I categorize two aspects. One is the tariff impacts that we're seeing. And so I think we probably sometimes have short memories, and especially after we go through different generations. But if we go back in time, in 1930, when we had the Great Depression in the US, it was based on tariffs that were implemented at that point that basically stopped the global trade. And at that point, was an extreme that the globe or the world was managing 56% on average of tariffs in all the materials that were traded. And today we're not at that level, thank God. But at the same time, it's a challenge for us to see how we can ultimately manage that in an effective way. The other part that I see today as part of this trade war that we're seeing today, it's more on phytosanitary and regulatory barriers that we're seeing that are being increased, especially in Europe, as a way to protect more the local industries, to protect more the local farmers. I think probably you have seen many times in France, farmers going with their trucks in Paris trying to make strikes against the government because of the arbitrage that exists, that they feel that they are not being treated competitively. And those are barriers that are very important, that are affecting ultimately the world trade, that it's impacting final consumers. So I think those are two aspects that we're trying to actively, on a day-to-day basis, navigate through and to try to manage it in a more effective way. But certainly there's a lot of volatility, right? And when you find probably a solution to something else comes into the play, and we have to be very agile to manage that.
I got to get my words together. Sorry. Right before the tariff threat, or about the time the tariff threat was going on, we started moving stuff into some bonded warehouses so that it would make it easier, because we've got a locked in price with our, let's say, our food safe panels and skid resistant tiles and stuff like that we have. So we'd move those. That was one thing that we did to counteract some of it. But the logistics costs have skyrocketed. The chartering a vessel to go to Europe, chartering a vessel to go to Latin America for our bulk oils. That's been interesting. and transit times have increased. So it's like, okay, what I used to classify as a 40-day transit time is now a 60 to 75-day transit time. Okay, that puts us in a whole nother category. So those are some of the games we've been playing with. But the way we're working around a lot of those is we have global offices. We have 6 main offices around the world other than here in the US. So we'll put product over there and then let the local offices sell it. So it makes
Yeah.
a little easier, but not great.
And I really like the point too that we always keep. I mean, it just goes back to what we say time and time again. Get yourself a good banker and get yourself a good logistics team because that's what it's all about, right? Thank you guys. Okay, so moving on. Next question. How have recent tariff regimes reshaped global commodity trade? That's right. Okay, yeah, we're going to make Renee go first. This
Yeah,
time.
well, as you can see, that's very close to my heart, right?
Yeah.
No, definitely, it changed dramatically our business, especially considering that if you think about the agricultural sector, probably today it's impacted twice to the average of the rest of the sectors in the U.S. And that's very material, right? And I said before, the downstream impact of that it's very important, and probably I will say that between 40 to 70% of that impact today is absorbed by the consumers, but the rest is absorbed by the whole industry. So we have been seeing important pressures in terms of margins. And as I said at the very beginning, we have been trying to be creative on how we can structure our trade flows, finding sourcings from other places where we can find raw materials that could be more competitive. Also, trying to balance imports and exports that we have in the US to try to offset the impact in the tariffs with the different incentives that we have today to mitigate the impact if we have the right quantity of exports that can support that. But definitely, it's an important disruption, and I think probably one positive side is that today there is more clarity on what are the regions or the countries that are more focused, and where is the eye of the hurricane. And I think somehow what I see is that this is something structural that I do see that it's going to be very difficult for the world to go back to where we were before, right? So I think because of this dynamic, I see that probably the situation that we have with China is going to be something structural that is going to take a long time with this situation, and I think we have to get used to it. And that's a big deal, right? When we see the presence that China is having and the pressure that's creating in the system, and also with this current administration, how they are running their commercial policies. I think we have to be prepared that it's going to be for probably many years that we're going to see that tension, and we have to be adapting ourselves to that new environment.
Thanks, Renee. Do you want to go next, Sebastian?
Sure. Just picking up on the previous question as well, the more regional approach, the shift to a more regional approach, it extends supply chains, longer cash cycles. We've also seen kind of multi-step process of commodities being transformed in a third party, either company or country, before entering the final market. And, for trade finance, that's significant because a lot of trade finance products rely on documentation that kind of shows origin and shows major transformation before it's kind of reaching their final market. So I think that's one of the ways that it's been most effective.
Very important.
We have because we don't import as much, we're not feeling a lot of the impact, except for when we bring in the big crude ships, but that's beside the point. But we have helped, I won't say eat the cost of the tariff going for a lot of the customers. We'll kind of meet in the middle. So we're working with the price. Yeah, it cuts into the margin, but as long as we still have a margin, it's okay. But I
do remember you talking earlier, like when we had a working session too, how your company kind of teed themselves up.
we did.
And reorged a little bit. Do you want to talk about that?
We put some products in bonded warehouses, juggled stuff around, and then we sell to ourselves. So we're not paying a tariff. We're not getting it from either side. So then the local offices will then sell it. We've had difficulty with the segment that does the asphalt laying equipment. They make the equipment and distribute it. You can't. You gotta help them with the tariffs on that, because that's going to cost them. So we've cut our margins to help with that.
And has there been like any what's the word I'm looking for? Not product specific, but like specialized builds that you're having to?
No, let's rephrase this. I haven't seen them.
Yeah. Okay. So we'll knock wood. Yeah.
I haven't seen them, but it's just been different.
Right. Very good.
Right.
So that kind of takes us into our next question, which it says, many say that volatility has become the new baseline. What does operating under continuous volatility look like?
So
This one's up for grabs. Go, Sebastian.
yeah, just add my 2 cents here. I mean, I think it's something that is important again to look at in risk management, operations, and financing together and not independently. Also, in commodities, secured financing facilities are very popular. So the automatic reporting of collateral can be very, very helpful to have an idea of what the net exposure is to a client. I mean, we see last week, for example, precious metals have a very volatile week, and the ability of bankers to understand the client's net position in moments like that is very, very useful to put it into context for everybody in the bank, right? So I think that's really what comes to mind. And then again, working with clients on possible flexible terms, whether we're talking about execution of accordions, if that is the case, or also aligning tenors for proper payment cycles to make sure that it's structured correctly. I think that's definitely something that can be done on the banking side. But yeah, I think transparency and automatic reporting, I think, would be very helpful.
Right. I mean, because this is where the pressure is really on you guys to perform as a bank, because they've already got their own pressures just trying to keep their product moving, trying to not, lose every margin that you have. So this is where the bank has to definitely step up and be nimble and meet your clients wherever it is they need, and let that, if they were heavy cash basis, let that line out. Yes. Do you guys want to just chime in on that?
Yeah, let me jump at first while my brain is working. When you have a letter of credit with 30 days bill of lading, 60 days bill of lading, and all of a sudden your transit time has increased, sometimes that's payable before the product lands. That makes for very unhappy clients. Customers aren't happy to pay before they get it.
Well, I'm unhappy for you too. Like, you're like, this wasn't the plan.
Yeah,
obviously.
And they know that. But So now I'm having to offer extended further terms just to make sure I can get the transit time covered.
And get your tap shoes out.
Yeah. I just say I wear my tutu that day.
Yeah, exactly.
Okay, let me put on my tutu.
Right. Yeah, I know.
Time to pivot.
Exactly.
So, I think to me, volatility sounds sometimes negative, but to me, it's an opportunity. I came from Cargill, where I spent 21 years of my career. And Cargill, it's a company, for those of you that probably you have heard about them. It's 40 years ago, Cargill was a $1 billion company in revenue. Today, it's probably $160 billion in revenue. And the best years that Cargill had is when we saw the highest volatility in the market. When there's no volatility, it's more difficult to make money. So I think that's where it's is the beauty of our jobs, which is how we can have the right partners to manage that risk effectively and to be smart on how we are navigating through those challenges or volatility. So ultimately, with the support of the market, we can help the companies to be more successful. So I just wanted to put that spin because sometimes when we think about volatility, everybody tends to have a negative perception about that, and that's not necessarily the case. So and especially in the agricultural world, and probably for those of you that are also in the agro space, you probably are a testament of this, right? That normally when the markets are flat, it's probably more complicated to make more profits, and certainly when you have a bull or a bullish ride, it's when you differentiate the companies that are well structured to manage that volatility effectively or not. So yeah, I think to me, I tend to see volatility more as an opportunity rather than a risk.
And one thing, if I may add, is on the banking side, one of the things that we see from our clients is strong risk management, right? I mean, for the commodity trading companies, the ability to manage that price volatility, manage price risk, lock in profits, that is what is incredibly important for the bank to feel comfortable that you have a client that is an expert in managing that risk.
And that's like, that's where your insurance comes in as well, right? I mean, especially when you're talking about goods that are perishable and things like that. I mean, you also have to be partnered with a good insurance that's going to, protect that.
So
Okay, so we are doing okay on time. So let's talk about what 2026. I know we've, kind of creeped into it. So what's your forecast for 2026?
just this that.
We would just do it. Yeah, he who laughs loudest gets to go first, Renee. There you go.
Yeah. So, I think probably 2026, it's a year where, as I mentioned before, I think probably the pressures that we're seeing with tariffs will remain in one way or another, right? So I think there are many factors on the geopolitical situation that also we have to see and see the impact of that. Example, what happens with Venezuela, which I grew up in Venezuela, so this is also a topic that is very close to my heart. And definitely, I think that's going to have implications, and somehow we have to see, other type of unpredictable situations like that may happen in 2026 based on the nature of the administration that we have. But again, right, that's going to be volatility that probably is going to come, and opportunities that are going to come as well. And I think so. In my opinion, tariffs will remain in one way or another, having the same pressure. And I will say that this geopolitical agenda will still remain at the top of the agenda to see how we can manage the impact on that in the food and feed industry.
We've been talking about the possibility of more countries, putting a risk on US dollar transactions, and that may hurt a whole lot more than I think it will. If you can only get so many US dollars out of a country in a month or because we had that problem in Venezuela and a few others, and so I'm carrying this debt. Well, we can't get the funds out. Okay, what other ones can we use?
Right. And that's something, is that something that you're putting in your risk mitigation tool bag is start offering like dual currency invoicing. I mean,
That's one we've been talking about, and that's one I'm not 100% comfortable with, because that's it's not paper.
right. Well, and it also, it adds another layer because now you're like, I need to hedge a currency in case I've got 30-day terms. And so I need to know and lock in what that rate's going to be. And then also hope that the dollar doesn't flux that much. And, it is all part of the picture.
And that's when I throw it back to the treasurer and say, this one's yours.
Yeah, not it. Okay, Sebastian, you want to go?
Yeah, I guess geopolitical alignment probably continuing. I think it's interesting to highlight, I guess, the energy transition metals and such that actually have brought in even more complexity rather than take away any from fossil fuels. So that I think will further continue to occur in 2026, and then. Structured products and financing, I think, have been very, very helpful to tie offtake. So I think would probably continue to see that as well as just overall financing really take a very prevalent role in trade.
Perfect. Okay, so we're getting pretty close. We do have a couple questions. I do just want to give the panel one more chance. If there's anything that you wanted to share that you didn't get to share already. We don't have to. I just wanted to,
Well, with that, no, I think probably in the context of what we're discussing today, I think from a banking perspective, there is an important role that we are expecting, right? Because I think more than ever, we are looking for support of more partnerships rather than just a lender. We want to have people that can understand our businesses, people can understand with us our challenges, our opportunities, and that together we can go after those. Because I don't think that we are anymore in a world that we can see these independent parties that only just are focused on one aspect. I think we both have to see from the same lens what we're trying to pursue, which is ultimately to drive the growth of the organizations and to ultimately find a common goal of on both sides, on the banking side and on the customer side.
Good point.
Yeah.
Okay, let's quickly take these questions. So first one, what is your risk appetite, extend credit terms, to do business with the African continent? Do you accept Africans' bank risk?
I'm going to generally say, if my salesman comes to me, I will investigate it. But again, I do my due diligence. What is the bank? What is the market? How extended do you want those terms?
365.
No, I'm doing good to go 120.
Sebastian just cringed too. He's like, please don't ask for 365.
Yeah, I think on our side, for the first question, yes, we do. We're starting to do more with Africa. Currently, we're importing more soybean meal from countries like Ghana, and we're exploring more opportunities in Nigeria as well. And we believe strongly in a model where we can connect and be a bridge between developing markets like Africa or Middle East or Asia to develop regions like North America or Europe. So that's part of our business model, in fact. So for sure, in the first one, that's part of our business model is to work with risk in Africa.
Okay, I'm just going to abbreviate it since we're kind of out of time. Do you guys have African bank risk, like for confirming and whatnot?
Our EMEA office would be much closer to that, so I probably don't have all the information there. But I know that that there's definitely business that SMBC does within the continent of Africa and with any banks in Africa. Yes.
Okay, and then we're going to take one more. We're going to do the margin one. So let's just answer in yes or no. And that way we can move on to let other people have their time. So
Yeah, it is not going to be sustainable to continue to cut into our margins. So something's got to give somewhere.
okay.
Yeah, in our case as well, and in fact, we're already taking action. So we are reducing product lines that are not profitable and investing in new product lines that are more profitable.
Awesome.
Okay. Thank you guys so much for your time. I really appreciate
Thank you so much.